With the collapse of 3 American banks this last week, Canadians are now wondering what would happen if a Canadian bank failed. And the answer to that question actually lies in Canada's more socialist-like political policies. Because unlike the American system, which is set up primarily for capitalism, Canada's banks have very much been set up to protect Canadians in the unlikely event that something bad were to happen. And during the Great Depression, the First and the Second World Wars, and the oil crises of the 1970s, not one single major bank in Canada has collapsed. However, there have been bank failures, the most recent being the failure of Calgary-based Security Home Mortgage Corporation, which happened in 1996. So it has been quite some time since a bank in Canada has failed. However, that doesn't mean that there aren't going to be bank failures in our future. And in this video, I'm going to discuss how certain types of bank failures would be handled depending on the type of bank that failed, and how you can protect yourself in the event that a bank does collapse. But before we get into it, my name is Nolan Mathias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video. Okay, so let's discuss bank failures and what would happen if a Canadian financial institution failed. But before we get into how you're protected in Canada, let me catch you up real quick on what's happening in the worldwide financial situation and why this is even a topic of conversation. So late last week, a bank called SVB, Silicon Valley Bank, failed in somewhat spectacular fashion. They essentially had a problem that consisted of them having too much money. So much money that they had to invest a significant amount of it in treasuries and other types of bonds. Now, Silicon Valley Bank specializes in banking for high-tech companies, which in 2020 and 2021 were all the rage. Obviously, companies like Amazon and Zoom and other tech companies did very, very well. But as 2022 rolled around and venture capital dried up, those same companies who had made a significant amount of money, in fact, the deposits at Silicon Valley Bank went from 44 billion to 189 billion between 2017 and 2021. Well, they stopped making as many deposits and started making withdrawals. Now, that wouldn't be an issue typically, except for the fact that rising interest rates created a scenario where the treasuries and the bonds that SVB had bought, as they're required to by law, had become significantly devalued. Now, this normally wouldn't be an issue because typically those bonds and those treasuries would be held until maturity, and the bank would get all of the capital that they invested in them back, plus whatever interest they were paid. Or, if interest rates hadn't gone up, they'd be able to sell them for pretty similar to what they had bought them for, or in a lot of cases at a profit. But because of this unique circumstance of rising interest rates, those bonds became devalued. And Silicon Valley Bank, in order to cover the amount of withdrawals that were coming out of the bank, which was to the tune of about $10 billion, had to sell about $20 billion worth of bonds. And those $20 billion worth of bonds created a loss that was about $1.8 billion. Subsequently, the bank had to go out and raise funds, and when they weren't able to raise $2 billion to cover those losses, the bank failed. Now, this shocked the banking system, and clearly there's been a significant amount of runout from this, but the Fed stepped in and backstopped the bank. And the reason they were able to do so is because they had all of those securities in place in order to back up the funds that were on deposit. And what the Fed did is basically set up lines of credits for the banks so that they didn't have to realize losses by selling bonds that had gone down in value. So in other words, they're going to be able to hold those bonds until maturity and get all of the money back for them. So the Fed found a really simple and elegant way to manage this situation and make sure that a significant amount of small to medium-sized banks in the US didn't end up failing as a result of similar circumstances. But that doesn't mean that what happened in the US didn't instill a significant amount of fear in Canadians and in general for people worldwide. And that's why we're talking about what would happen if a bank failed in Canada. And while it's rare for Canadian banks to fail, it has happened. In fact, financial institutions have failed a total of 47 times since 1967, according to the CDIC. Of course, the CDIC being the Canadian Deposit Insurance Corporation. That is the organization that's responsible for insuring deposits in the event of a bank failure. Now, before I get into what you need to do to protect yourself, let's start by talking about how CDIC insurance works. So CDIC insurance covers you for $100,000 per insured category per financial institution. So what does that mean? Well, the CDIC has a really great image on their website showing exactly what this means. So first and foremost, you need to understand what the different types of insured categories are. So these are things like the amount of money that you have personally. This is things like money that you have in savings or in trust for somebody else. This is your tax-free savings account, your retirement savings account, your retirement income account, your education savings accounts, or an RESP, and your savings for a person with a disability. So basically the big things like your savings account, your TFSA, your RESP, your RRSP, and most other types of registered savings accounts. Now, you're protected at up to $100,000 per category per institution. So in theory, you're covered for up to $800,000 per institution, depending on your account mix. Now, this includes coverage for things like your general savings account. This includes coverage for things like guaranteed investment certificates, money orders and bank drafts, certified checks, and foreign currency. So basically anything that has zero risk or very low risk of losing value very quickly. Now, what's not covered is mutual funds, stocks and bonds, exchange traded funds, and cryptocurrencies. Now, the question then becomes, how would a bank failure be handled in Canada? Well, if it was a small regional bank, similar to the ones that failed in the US this week, or if it was a large credit union, the CDIC would step in and they would insure all of the deposits again up to that $100,000 per account. Now, in the past, the last time that a bank failed in Canada, 1996, it took about 3 weeks for people to get their money. That's because that was the amount of time it took for people to get their checks written and cashed. But nowadays, things happen a lot faster with respect to finance, and in all likelihood, if a bank failed, the CDIC would be issuing funds within a 3-day period. So you would have a very short period of time before you would be able to access your money. And my recommendation would be, is if you have deposits at a small regional bank or a credit union or anything that's basically not one of the big 6 banks or an organization that's not owned by one of the big 6 banks, then I would make sure that the money that you have on deposit at those institutions is less than $100,000 per account. And by the way, if you want to know if your institution is covered by CDIC insurance, you can simply go to the CDIC website and simply go in and enter the name of the organization to see if you're covered. Now, it is possible for a small Canadian bank to fail. That is obvious. It's happened before. Smaller financial institutions have failed as well. However, the bigger question is what would happen if one of the big 6 banks were to fail? Well, because of the importance of the big 6 banks to the Canadian financial system, it is highly unlikely that one of those banks would be allowed to fail. In fact, even if you had more than $100,000 in one of the big 6 banks and it did fail, the likelihood of the federal government not backing those deposits is almost slim to none. And in the event that a big bank did fail, what's more than likely going to happen is the CDIC or the Office of the Superintendent of Financial Institutions would step in and take over that organization. And you would more than likely see a 2008 style bailout of those banks in order to protect the Canadian financial institution, Canadian savings, and the economy as a whole. Now, that's not to say that you shouldn't take steps to protect yourself. I know my wife and I keep money at multiple different banks. We don't have all of our eggs in one basket, primarily because we know that certain banks do certain things better than other ones, but having our money at multiple different institutions also has that added safety effect, especially when you look at it from the perspective of being underneath that $100,000 per insured category at each institution. So if you're smart about your money and you're smart about making sure that you're diversified in your banking, there's almost no reason why you should be exposed to a greater amount than what the CDIC insures. And if you are carrying more than $100,000 per category at any one financial institution, especially if it's a small one, don't be like the high-tech startup founders who made the mistake of keeping it all in one place. Make sure your money is diversified across multiple banks, and also make sure that you've got multiple bank accounts, so if you need to move it from one institution to another quickly, you can do that. You don't have to worry about going and setting up an account elsewhere because you'll already have it in place. And at the end of the day, a Canadian bank failure is probably not something that you should be worried about. However, that's not to say that it won't happen. It's the major surprises like the 2008 financial crisis that change our worldview permanently. And while we haven't seen a major bank in Canada collapse, it's not to say that it won't happen. But by taking a few steps to protect yourself, it's highly likely that in the event that it does happen, you can minimize the damages. And if you want to see how the damages were minimized by the Fed in the US and why it's not going to cost taxpayers any money, make sure you check out these videos right here.